Welcome back to another episode of Capital Finesse. Happy to be back. It's been a while. I have been trying to do the short videos instead of long version, but sometimes some of these topics you do need to talk more and then transition to short videos. So without further ado, let's just dive into the episode. All right, first and foremost, I really want to talk about my last video, the last short video I post, and it was about B.Riley investment banking. If you haven't watched it, you can go to the channel and make sure to check out the 4 parts. I'm going to briefly talk about it a little bit in this episode with their new update. But if you haven't watched, make sure to check it out on the channel. There's four part short videos, explains the whole problem that this bank has and the whole research. That is about B.Riley. Kind of I posted as a short format, and I didn't really include it in anything as a longer version or even this episode. I just want to briefly go over it. And really what happened with them, they actually announced the new hire. I think they hire a senior capital structure advisory with to kind of help them with the whole issue that this bank has. But as you kind of could guess, if you have watched the video, you will understand the reason behind all these PRs is to keep them in the market and be able to really hide most of their problems and a lot of issues that they have been really exposed to. So if you get a chance, just go back, watch those short videos. I think it's useful if you want to know more about this bank and the story behind it. It's very interesting. So on the next topic, and our first topic, basically, I'm going to talk about some of these bankruptcies that happens in the past few weeks or so. 2 of them were mainly well-known. Tupperware, an old American companies back post-war generation. It's a plastic container company, well known. They actually invented this whole plastic container back in that time, and they were driving pretty much the market for this product. Except they couldn't really continue with the actual problem, which was in e-commerce. They couldn't really continue with that even after they get heavy rebranding, restructuring the company, and heavy debt. They still couldn't really continue, so they end up filing for bankruptcy. I think last week, and then one of the reason that they couldn't really restructure was that the problem with, even post-COVID, some of these Amazon products, Amazon sellers, or Amazon or e-commerces, mainly other brands, were more trendy, and they couldn't really continue with the trend. So that was kind of like the, interesting one on the radar. So back in 2022, they took a 880 million loans from JP Morgan and other banks like Bank of America. So they end up really exacerbate the problem instead of fixing it. So Tupperware was the really interesting company, and I think they have only 7.4 million in cash, but they cannot really spend it because their lenders need to approve that. That's the only thing they have at the moment. I think the main goal should be, if anything, if any private equity going to acquire them or restructure the whole business. But this is a very old idea, and no one's really care, especially when things got into more of environmental friendly products comes into the market, or people tend to really interested in other sort of plastic container. However, they were huge in the market, but things definitely really didn't work out for them, and they had this very interesting advertising back in 1950s, and they kind of continued that concept in today's market and commercial advertising. But obviously, comes to an end, and on top of this, we got Big Lots. It's another retail. Retail struggle continues, as it's really predictable. Most of these retailers, like Express, also lots of other brands that file for bankruptcy, and it's not really out of expectation. And but for Big Lots, things are different because Big Lots also have this, activists, Nexus Capital. They're interested to distress business like Big Lots, so they're probably going to acquire and restructure the company because Big Lots gets more foot customer compared to like Tupperware. So I mean, you get a lot of these companies like Ross, TJ Maxx, or Home Goods, or all these little companies that, they're not little, obviously. What I mean is they're not really in the eyes of the market, but they're very successful in terms of the sale. But Big Lots have this kind of similar concept. So, at the end of the day, retailers are not going to be standalone forever, in my opinion. So in the next one, we're getting to this Intel situation again, and how much they're really struggling. And the recent news came out about a giant private equity, Apollo investment firm, that they're going to invest. And this is a good sign for Intel, because at the same time, it's also interesting because why Intel is not really thinking or planning to restructure. So they're sort of looking for an exit. The CEO is kind of out of ideas. The problem is they cannot really compete. But with this investment, this will definitely attribute to their becoming more successful in the era of chip making. So yeah, this definitely benefits Intel, and I think why Apollo decided to really do this investment is they want Intel to regain leadership in chip manufacturing compared to this. TSMC's, Taiwan Semiconductors. So this is a huge step towards just being independent in terms of chip making, which is a positive things to look at, and I think it really attributes to more success in the future for them. And nothing so much so far as the deal goes, but obviously we can kind of look at the overall picture and see how giant is this Apollo is, and how they can really invest into Intel a lot easier because of their reputation as well. So yeah, and from this, I don't want to really talk about, like I said, I want to keep everything short format as well. And the interesting one that in connection to this sort of, I guess, chip making news, on the other hand, we got this news on semiconductor, supermicro computer, which is in the semiconductor sector, SMCI, well known for their manipulation and accounting fraud and many other things that this company does, and they hide it from the public mostly. But after the news came out from a short seller Hindenburg research, and some of these interesting thing. I'm not going to really dive deep into the SMCI in this episode. I will make a separate video for it. But for now, I want to kind of briefly talk about it and how it exactly, this research of Hindenburg really shows SMCI really violated this, U.S. export ban by selling their product to Iran and Russia, even after, this is after Ukraine war, and lots of problem with their CEO and the brother of the CEO. And this chart really explains a lot, which is according to Hindenburg research, really after the war. This is Russia invade Ukraine, and their third-party exporter, which mostly you can kind of see in this part, that where they sell and what value they sold these, and most of these companies are Russian, and they just exported. And this huge spike was driving the massive profit to them. So, it's a U.S. company that basically decided to break every single laws. So I'm not going to really talk about it, but just briefly, like I said, the updates on their research probably come out in the future. But for now, it's very interesting to read. If you haven't read their report, make sure to go check it out. So on the last topic, I'm going to talk about Carl Icahn. This is also a report and news and updates on short activist Hindenburg research and Carl Icahn. If you don't know who's this Carl Icahn is, just do a Google simple search. You will see who is this guy. Carl Icahn is an iconic investor, activist investor back in 80s, and from that time he really invested in so many distressed assets, and has been successful in one way or another. But the problem right now is a margin loan problem. Back in May 23, Hindenburg Research released a short report on that on Carl Icahn Enterprise. They basically claimed that this was significantly overvalued, with its market value trading at eye-watering 218% premium to its NAV, which is very interesting. And then for comparison, most of similar firms trade much closer to their actual value. So this raised a lot of red flags for investors, but that was just basically the starter. And then pretty much turns out to 65% of Icahn personal holdings is in Icahn Enterprise. And it's very interesting because, as you can see, that this is the value of his stake in his company, and so this brought another issue for him, which he used a lot of collateral for his margin loans, And this is basically a huge deal. Some of these margin loan, it only works with driving the price. But if you look at their price action and overall performance and the comparison with S&P and the huge slippage after the SEC charges him and more news came out, and turns out, all the research of Hindenburg was not all, what most of the allegation was correct, and still in that process, and still there's an investigation going on. So yeah, I mean, pretty much he's in that financial tightrope basically, and to covering, he needs to sell the stock to cover his loans, and not getting a margin call. And this margin loan situation raises a serious question on the sustainability of the company's operation and its ability to keep paying out dividends, because they're very famous with their dividend things. But Icahn Enterprise biggest selling point to investor was just this dividend part. In fact, just recently they slashed the dividend by 50% from $2 per unit to $1. And as you can kind of see, this is part of their Hindenburg research report, that this element basically explains that if they return your money into your dividend. So this was very this is a huge red flag when you invest in these funds. So according to Hindenburg, Icahn investment have lost around 53% of their value from 2014 to 2022, which is a massive underperformance, especially when you consider like S&P that really doubled their performance. I mean, if that's their benchmark, usually when you compare with the beta, you want to have some sort of outperformance when you invest in a fund. So that definitely is not the case anymore with Icahn Enterprise. So pretty much all these investors are investing into him in his enterprise because of the status of the founder. So I mean, yeah, that was very interesting. Because some of these investors fully they don't really understand the overall return. They just simply think about one factor, which is the person behind it, and whoever it is has a status like Carl Icahn, so they will do that. And then so this comes down to the lower interest rate environment, and they pile up the debt, obviously, and this is attributes to having those environment, and then now daunting and not really giving them a return. So in the other aspect that Hindenburg kind of put it is that if you invest $9 into the company for a value of $32, you will get back $2 of your own money per quarter. So this comes down when they notice that 86% of the distribution of these dividends represent the return of capital, not the actual dividends. So it's very interesting. That's part of how they really structure. So Icahn has to really deal with so many problems at this time, and this was interesting. Obviously, I'm just reading what reports are and what is interesting for me, and kind of look at it. But feel free to have your own opinion, look at things differently. I'm not here to tell you this is good or bad, but this is just the perspective that I have. This is just what I find and interested to talk about. and nothing above that. So yeah, that's it for this episode. I hope you enjoyed it. I hope you liked it. Make sure to thumbs up, subscribe, so I can do more of these. And I will do more short version. Try to keep everything shorter to be more, I guess, less spending in watching. But some of these topics you really need to go into the detail, have a long format, and yeah. Thanks for watching.